Hey, welcome back to YT Finance, where you can learn about the knowledge that I obtained in business school by studying finance, accounting, and economics. Today we are talking about the stock market and why it's pulling back right now, why cryptocurrencies like Bitcoin are also correcting in their prices, and why investors think that the stock market could crash in 2022. I will also go over some tips and tricks to keep your money safe during a stock market crash, and I will keep you updated on the latest stock market news. Remember to go and smash the like button right now for more videos like this one. Comment down below if you think the stock market will crash or not. Turn on all subscription notifications to stay informed, and now let's get right into today's stories. So official news has come out from the Federal Reserve about their restrictive monetary policies, which means that the Federal Reserve has been very hawkish lately. And if you didn't know, hawkish behavior is basically the intent or willingness from the central banks to allow interest rates to rise in order to keep inflation at bay. Many investors have been talking very negatively about inflation, so to fix inflation, the Federal Reserve is deciding to increase interest rates. So the era of easy money monetary policies is now ending, so the market is then freaking out and people are taking profits. If we look over at the S&P 500, and I'll use ticker symbol VOO, so if you would have just put money into the S&P 500, you would have made around a 22% return in the past year, and we can see this from this very positive slope right here. However, recently the stocks, especially technology stocks, have pulled back very drastically, as we can see from the negative market sentiment surrounding technology stocks and the Nasdaq 100, ticker symbol QQQ. So with the fear of the easy money policies now ending, investors are taking their money out of growth and technology stocks, and they're investing more into value stocks to keep their money safe. The chief investment officer at Bleakley Advisory Group even said that there is no question that the Fed members are becoming more worried about the higher inflation that they have so aggressively tried to stoke. So basically, the Federal Reserve cannot keep inflation under control anymore, and that's why they are thinking about raising interest rates sooner than anticipated. The problem here is that the markets have become very spoiled with the Federal Reserve's very liquid and generous policies, which has made it very easy to invest into stocks. The majority of stocks that you would have invested in during the last year and a half or even 2 years could have experienced very intense growth, and now that growth is going to end because of the policies that the Federal Reserve is thinking about putting into place. And this has affected more things than just stock assets. It has also affected and impacted cryptocurrencies. The CIO of Infrastructure Capital Management says that we believe that the dominant theme for the market in 2022 is not Fed rate increases, but rather the reduction of liquidity injections that the Fed will complete by the end of the first quarter. He goes on to say, the Fed's unprecedented injection of $120 billion of liquidity into the capital markets per month heavily favored higher risk speculative investments such as meme stocks, money losing concept stocks, and even cryptocurrencies. And now that the Fed is threatening to lower these liquidity injections over fear of inflation, it is scaring investors, which are liquidating their cryptocurrencies as well as their high growth technology stocks. This is why some investors are taking their money out of the overall stock market and they're investing them into bonds, which is much safer. Others are running to commodities like gold because surprisingly, from the start of the year, gold has outpaced the S&P 500 as well as Bitcoin. If the Federal Reserve decides to increase interest rates, it's also going to increase the yields of the 10-year Treasury bonds. And right now it sits at around 1.7%, which is a pretty good return for bonds. It's almost at the same level that it was before the pandemic, which was around 1.9%. So to keep their money safe, if they think that the market is going to crash or if we're going to have a pullback, bonds are going to be one of the safest options. However, the bad news is that these higher interest rates are very detrimental for high growth and technology plays that rely on future cash flows rather than their present values, and one that comes to mind would be Palantir Technologies. However, while stocks like Palantir, SoFi, and even stocks like PayPal are pulling back right now, the market is trying to hedge against the potential of how the market will react when the Federal Reserve actually starts implementing these higher interest rates in the economy. Surprisingly, cryptocurrencies have also pulled back along with the stock market, such as Ethereum, Binance Coin, and Solana also seem to be falling because Bitcoin is the dominant cryptocurrency and normally the cryptocurrency market follows its lead. Major fear has crept into the mind of investors ever since the Federal Reserve chairman named Jerome Powell admitted that inflation is not transitory and that higher inflation is expected. Investors were originally given false hope that the inflation was going to be transitory and that it would somewhat fix itself without much monitoring from the Federal Federal Reserve. However, in their most recent meeting, officials from the Fed said that they are thinking about increasing interest rates as soon as March. Now, this could end up working in Bitcoin's favor because Bitcoin is supposed to be a hedge against inflation depending on how you view Bitcoin and other decentralized cryptocurrencies. Cryptocurrencies are supposed to weather inflation rather well and retain their purchasing power, unlike fiat currencies like the United States dollar. However, crypto naysayers think that Bitcoin and other cryptocurrencies will crash when stocks pull back even more once the Federal Reserve implements these higher interest rates, because Bitcoin acts more like a growth technology stock rather than its own inflation-fighting store of value. So in turn, this could be good news for Bitcoin if Bitcoin is truly a good hedge against inflation, and it's coming at a perfect time as many of the central banks are warming up to both rising interest rates and the adoption of some cryptocurrencies. Now, if the stock market decides to pull back based off of the fear that the Federal Reserve has put into investors' minds, these are some things to remember that could save your portfolio and even cause your portfolio to outperform other people's portfolio. If the stock market crashes, pulls back, or even has a correction, view this more as an opportunity and not a time to be negative. Because if this did occur and you have any extra cash, it's going to be a perfect buying opportunity because things like stocks or cryptocurrencies are going to be trading at a fantastic discount. Looking back to major crashes for the stock market specifically, such as the Great Depression, the turbulence in oil prices, cryptocurrencies rise and fall and now they're rising again, the overvalued technology bubble in 2000, and even the Great Recessions as recent as 2008, after every single one of these crashes, the stock market has always recovered and returned growth to its investors that have stayed the course. One thing that might be very detrimental is pulling money out of the stock market. So if you liquidate your stocks, you're not only going to have to pay long-term capital gains or even short-term capital gains in some instances, and you just have a wad of cash, that's probably not going to be the best option. If anything, the safest thing would be to pull out of growth stocks and put money more into blue chip stocks that produce a dividend, because in market downturns, dividend portfolios really shine. If we look at the history of the stock market and we account for inflation, the average annual growth or compounding growth rate of money in the stock market would return around 7%. And this is going to be around 10 times higher than what you would have earned if you cashed out of the stock market during any one of these either crashes or recessions. So just based off of historical data, if you either left your money in the stock market or transferred out of growth stocks more into value and dividend stocks during a downtrend, you're going to come out on top. Even if you would have just held your growth stocks through the turbulence of the stock market and didn't sell anything, statistically, you would come out positive in the next 2 to 3 years. So one of the worst things to do would be to pull your money out and keep it in cash, because you will most likely miss when the stock market recovers, which means you missed out on fantastic returns. But if your portfolio is very risk averse, which is what I like to do because I'm a long-term investor, holding blue chip stocks or dividend stocks are going to be your best bet during a market downtrend. But what do you all think? Comment your thoughts down below. Remember to smash the like button on this video, subscribe and turn on all notifications if you are new, and I will see you in the next YT video.